For decades, going to college was seen as the surest way to get ahead, a ticket to better jobs, better pay, and a better life. But for millions of Americans, that ticket came with a catch, a massive, growing debt they're still trying to pay off. Student loan debt in the U.S. now totals $1.7 trillion. That's more than Americans owe on credit cards and car loans combined. It affects over 45 million people, many of them still paying off loans decades after graduation. Welcome to the Mechanics of Money, where we make sense of the most intriguing money questions. Today we're asking, can America afford to erase student debt? And if so, should it? It wasn't always like this. In the 1960s and 70s, a college education in the U.S. was affordable, even at top universities. State funding kept tuition low. Grants were widely available. Most students could graduate without borrowing a cent. But starting in the 1980s, things began to shift. State and federal investment in higher education declined. Colleges raised tuition to make up the gap. The government started issuing more loans to help students cover the cost. At first, it seemed like a win-win, more access to education, more flexibility in funding. But over time, the system snowballed. In 1990, total student debt sat at around $100 billion. 30 years later, that number has grown 17-fold. The average student borrower today leaves school owing around $37,000. But many owe far more, especially those who pursue graduate degrees. And interest keeps compounding, meaning many borrowers end up paying back twice what they originally borrowed. If we wiped the slate clean, eliminated every outstanding student loan in the country, it would cost about $1.7 trillion. Roughly 92% of that debt is held by the federal government. So, in theory, it could be canceled with a stroke of a pen. No need to negotiate with banks or private lenders. But that doesn't mean the cost disappears. That $1.7 trillion would simply shift onto the government's balance sheet. It would either be paid for with higher taxes, deeper deficits, or cuts to other programs. To give that some context, $1.7 trillion is about 27% of the entire federal budget. It's more than twice what the U.S. spends on Social Security in a year. It's equivalent to funding the entire Department of Defense 2.5 times. Even spreading the cost over 10 years would require $170 billion annually, still more than the U.S. spends each year on transportation and housing combined. So yes, the government could technically afford it, but doing so would require major trade-offs. Canceling all student debt wouldn't just help individual borrowers, it would send shockwaves through the broader economy. First, there's the immediate financial relief. Tens of millions of people would see their monthly budgets suddenly free up. A $300 to $500 loan payment disappearing could make the difference between just getting by and actually getting ahead. Freed from debt, many borrowers would start spending more. Restaurants, retailers, travel companies, and local businesses would all see an uptick. This kind of consumer activity doesn't just boost revenue, it creates jobs. Second, credit scores would likely rise. Student loans are installment debt, and late payments can drag down credit for years. With balances erased, borrowers would have lower debt-to-income ratios, making it easier to qualify for mortgages, car loans, and even rental applications. That has a direct effect on home ownership. Right now, younger Americans are buying homes 8 years later than their parents did, largely due to debt. Canceling student loans could accelerate home ownership, which fuels construction, real estate, home improvement, and related industries. Third, mental health and well-being would improve. Studies show that student debt is linked to increased stress, depression, and even physical health issues. People with loans report higher anxiety levels, and in some cases, delay important medical care due to financial strain. Debt cancellation could reduce this pressure overnight, leading to better health, better productivity, and better family outcomes. Fourth, entrepreneurial activity could rise. Starting a business often requires risk and a good credit score, but many would-be founders are stuck. They can't qualify for loans. They can't afford to take a lower income during the startup phase. They stay in jobs they don't like, not out of passion, but necessity. Removing student debt could unlock this workforce. Studies have shown that student debt makes young adults less likely to start businesses, especially in low and middle-income communities. Debt relief could mean more innovation, more small businesses, and more upward mobility. Fifth, there's the macroeconomic effect. A 2018 study from the Levy Economics Institute estimated that canceling student debt could raise GDP by up to $108 billion per year and create up to 1.5 million new jobs annually over the next decade. This is due to increased consumer spending, job creation, and higher productivity. But these ripple effects aren't all positive. Critics warn about inflation. Injecting more disposable income into the economy without increasing supply could push prices higher. However, economists are divided. Some argue the effect would be modest, especially since the debt relief would happen only once, rather than as a recurring stimulus. Others worry about fairness. Is it just to forgive loans for some while others paid theirs off? Would it incentivize colleges to raise tuition further, knowing that future debts might also be forgiven? And finally, the question of precedent. Would one forgiveness program open the door for more? Mortgages, credit cards, medical debt, where does it stop? These are real concerns, but they must be weighed against the economic boost and social progress that large-scale relief could bring. Student debt relief isn't distributed equally. Borrowers from graduate programs like law school or medical school often carry six-figure debts, but they also tend to earn higher salaries and are more likely to repay those loans eventually. Meanwhile, low-income borrowers frequently owe smaller amounts, but are more likely to default. That's because the real crisis isn't always about how much debt people have. It's about how much they earn in relation to their debt. A person with $20,000 in loans and a $25,000 salary is far worse off than someone with $100,000 in debt and a $200,000 income. That's why many economists favor targeted forgiveness, such as wiping out debt for borrowers under a certain income level or offering relief based on profession, like teachers, nurses, and social workers. Another suggested proposal is to forgive $10,000 per borrower would eliminate debt entirely for around 15 million people and cost the government about $370 billion. Still a big number, but a fraction of the full cost. The U.S. is unique in how it funds higher education and how much responsibility it puts on students. In Germany, public universities are free. The government covers tuition costs entirely, and students graduate with little to no debt. In Sweden, tuition is low, and the government offers generous living stipends. Loans are available, but repayment is gradual and based on ability to pay. In the UK, graduates only begin repaying student loans once they earn above a certain income threshold, currently around £27,000 per year. Payments are capped at 9% of income above that level, and any remaining balance is wiped out after 30 years. That's the income-driven repayment model, and it's gaining traction in the US too. Canceling all student debt isn't the only option. Here are some other policy ideas on the table. 1. Income-driven repayment. Tie loan payments to income, with forgiveness after 20 to 25 years. Already used in the US, but currently underutilized and poorly understood. The UK follows a similar model successfully. 2. Public service loan forgiveness. Allow debt cancellation for people working in non-profit, education, or healthcare sectors after 10 years of service. 3. Interest-free loans. Let borrowers repay what they took out, but not a dollar more. 4. Tuition regulation. Limit how much colleges can raise tuition each year, especially at public institutions. 5. Debt refinancing. Allow borrowers to refinance federal loans at lower interest rates, just like a mortgage. And finally, of course, there's the long-term fix. More public funding for higher education to reduce the need for loans in the first place. Student loan forgiveness is a deeply polarizing issue. Supporters argue it's a form of economic justice, correcting decades of underinvestment in education and offering relief to millions crushed by a broken system. Opponents call it unfair, especially to people who didn't go to college or who already paid off their loans. They also worry it might fuel inflation or encourage colleges to raise tuition even more. In 2022, the Biden administration proposed forgiving up to $20,000 in federal student debt per borrower. But the plan was struck down by the Supreme Court, raising questions about what authority the executive branch has in this area. Going forward, any large-scale forgiveness would likely require new legislation, a tough sell in a divided Congress. $1.7 trillion is more than a number. It's a policy decision. It's a reflection of national values. And it's a burden carried by millions of individuals trying to build their lives. Erasing student debt would be expensive, but so is leaving it in place. It slows down the economy, it discourages risk-taking, it stifles innovation, and it traps people in financial quicksand before they've even had a chance to stand on solid ground. So the question isn't just, can we afford to cancel student debt? It's, what kind of future do we want to invest in? Thanks for joining us on The Mechanics of Money. If you found value in exploring this topic, consider sharing your thoughts or questions in the comments below. Until next time.